Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us. Here are some of the stories we're tracking for you in the BNN Bloomberg newsroom. Canada's economy stalled in November with GDP flat compared to the month before. Economists were expecting a rise of 0.1%. Data from StatsCan shows the drag came from goods-producing industries, which fell for the third time in 4 months. Meanwhile, services industries saw an increase driven by higher retail spending. Looking ahead, StatsCan says GDP likely rose 0.1% in December. We're tracking shares of Canadian National Railway today. It's up about 3%, 3.2%. Down, excuse me. Looking at those numbers too quickly, they're down almost 3.25. Now the company reporting higher profit and revenue for the fourth quarter thanks to better freight volumes and improved operational efficiency. Revenue rose to $4.5 billion, and CN boosted its dividend by 3%. The rail company expects volume growth to be flat this year as it expects to spend roughly $2.8 billion in capital expenditures. Shares of Imperial Oil also in the red, down by 3.6. The oil producer and refiner posted profit and revenue in its latest quarter that fell due to lower oil prices. Imperial's net income also saw a 60% plunge due to charges related to the write-down of an aging oil field. In addition, production from its oil sands assets in Alberta also saw a decline due to weather conditions. Despite the disappointing quarter, Imperial raised its dividend by 20%. And to the markets right now. Look at the TSX. That's being driven by metals right now, off by 2.36%, down, closing in on 32,000. That's how much we've seen of a drop. Look at that, more than almost 800 points right now. Driven by those metals south of the border. You can see not much better, but a little better, I guess, if you want to look at it that way. S&P 500 off by 0.35, Dow by 0.57, NASDAQ by 0.46. A lot of this reaction to Trump's proposed head of the Fed. Gold and silver prices continue to slide after reaching record highs earlier this month. The sell-off that began yesterday saw gold drop as much as 8%, silver fall below $100 an ounce. Let's get more on this from Jay Hatfield, founder, CEO, and portfolio manager of Infrastructure Capital Advisors. Jay, thanks very much for joining us.
Thanks, Roger. It's great to be back.
Never a dull day. The gold and silver right now, it seems to bounce back slightly, and that's a relative term, and it's still up. But your thoughts on what's unfolding in the markets right now?
Well, we had thought before today that the gold rally had morphed from a fundamental rally driven by looser Fed policy and global central bank buying to a momentum trade. And you can kind of see that the other momentum trades in the US, like Bitcoin, tech stocks, meme stocks, have really lost energy. So we were going into this hyperbolic upward move in metals. But Kevin Warsh is unambiguously the most ultra hawkish Fed governor, maybe of all time. So it's a catalyst to break the upward momentum. We'll have to see whether it resumes, next week after this news is fully absorbed. But it pretty much, the drop was well-timed with the leaks that occurred about Warsh last night.
And now with that, you call him one of the most hawkish of all time, but he was, and then I've been reading some reports that also are saying that he's pretty much fallen in step with Trump since 2009. Do you see him remaining hawkish if and when he does become Fed chair?
Well, it's a great question because it's really nuanced. We're forecasting that PC core rolls to 2. So he's actually ironically better positioned to implement rate cuts in the short run because he is viewed as being very independent, very hawkish. And Kevin Hassan was not. That was the worst camp was out campaigning against him on that basis. So ironically, we're probably more likely to get 3 cuts this year. We're worried more about the long term, maybe even after Trump's out of office, because it's a 4-year term, that the new Fed chair overreacts to just a modest increase in inflation like he did with the FOMC in the mid-2000s, which precipitated the great financial crisis. And importantly, Warsh remained hawkish incorrectly, even after the financial crisis started, and is a big enemy of QE, which we think is, or at least back then, was a mistake. So we're more worried about the long term, and that's really why, other than gold and silver, you're not seeing much reaction in the U.S. stock market or bond market, for that matter.
Now, you're forecasting GDP growth of around 3.3%. Does Warsh have a factor in that at all, or is that brought into it?
It's absolutely critical, because when it comes to GDP, it's important to look at the components. You know, we have this GDP now forecast that comes out of the Atlanta Fed is at 5.5%. So you might say, oh, the U.S. economy is booming, but it was really 3% of that growth came from the volatile inventories and net exports. In fact, it got revised down by a full percent yesterday. So really, growth this year in the U.S. is going to end up about 2.6. And we're forecasting 3.3, but it does assume, to your point, that we get those 3 rate cuts and we have a recovery in investment, because investment in the U.S. has been flat this year, strong on the tech side, very weak in housing and construction. The 30-year mortgage has come down to below 620 from over 720. It's critical we get those rate cuts, keep mortgage rates hopefully below 6, get a recovery in housing, and then have a normal economy where you get relatively robust personal consumption, good investment, and a little bit of government.
And you feel the U.S., the Fed, is behind the rest of the world?
Absolutely. The rest of the world has an advantage in that they can calculate shelter inflation properly. So we have a built-in 6-month lag, which should be illegal. It's highly incompetent and illegal, arguably. But also we use renewing rents. But if you look at the ECB, they just use a relatively market-based index. We publish our own CPI and PCE, and it shows PCE core is already below 2, CPI is 1.2. If you mark shelter to market using modern data gathering techniques, including this thing called the internet that was invented not too long ago, not use 1970s technique. So the rest of the world, that's probably the rest of the world's biggest advantage of the U.S. is they know how to calculate inflation.
All right, let's talk a little bit about the markets. You're saying the S&P 8,000 is the target. Yeah, and I want to get into, we're almost out of time, so I want to get into a couple of stocks that you're looking at. KKR is the first one.
Yeah, that's way more compelling than it was even a couple of weeks ago. There's a major freak out going on about private credit. They're not that reliant on private credit. They haven't taken any losses. They're better than usual. Super low multiple, great growth. So that's really our number one idea, and it's gotten more compelling recently because of the most recent freak out about private credit.
Okay, and one other, we just want to get Amazon, one of the big ones.
Reporting next week, sorry. A dog of the Mag 8. It's always good to look at valuation going into prints, earnings prints. It's always good to have a modest valuation. So we think the risk reward is good going into earnings.
Okay, we're going to have to wrap it up there, Jay, but thank you very much for joining us. Have yourself a great weekend.
Thanks, Roger.
Jay Hatfield is founder, CEO, and portfolio manager at Infrastructure Capital Advisors. Up next, Apple beat in Q1. We'll find out what investors think after this. Apple reported its first quarter, beating on both its top and bottom lines, citing staggering iPhone demand. Let's get more on this now from an analyst who is bullish on the stock, Dan Ives, managing director and global head of tech research at Wedbush. Dan, thanks as always for joining us.
Great to be here.
So the bullish hasn't changed. What jumped out from these results? What did you like? What are you a little concerned about?
Look, I mean, iPhone numbers were, I think that was even better than best case. I mean, if you look at China, that's now been a real big tailwind. There was a headwind. Services was really strong. Look, I think the only blemish is just given the increasing cost of memory, you'll have, maybe some pressure for Apple over the coming quarters, when it comes to margins. But I think actually they're going to be able to hold that pretty strong. Look, I think the stock being sort of flattish to down, it's really about the AI strategy. That's what investors are focused on.
And they're working, though, on that. They hopefully are trying to get back into the game with Google. Do you feel that's the right way to go and it's the solution?
I think that's the only way to go. I mean, the reality is they were late to the game. They watch it from the stands. It's a fourth industrial revolution. That's been the frustration as an Apple investor that you've seen, from investors. And I think it really comes down to they need to be aggressive when it comes to AI, Google, as well as outside talent, as well as acquisitions.
What do you think happened that they were so hesitant on that?
I think it's part of the DNA in Cupertino, where they're just close to the vest, don't do acquisitions. I think it was a strategic misstep. I think Cook's recognized it, and now it's about turning that around.
And you think he can? You think doing this will be what they need?
Look, it's the biggest install base in the world when it comes to consumer. You have 1.5 billion iOS devices. Of those that are iPhones, 2.5 billion when you put it all together, and that they have the biggest install base in the world. Now, I think monetization can be $75 to $100 per share when it comes to the AI monetization opportunity.
So there are the opportunities. Let's go back to China. What did they do right in China?
I think pent-up demand was there. Look, iPhone 17 has actually been under the radar, almost a sleepy, massive upgrade cycle. And I think China, we've seen the strength there front and center. I think there was geopolitical tension as well, which hurt them if you think about over the last year, and that's settled. Look, Tim Cook's 10% politician, 90% CEO.
And North America, how's it comparing with China when it comes to sales?
I mean, I think okay. Look, it allows some more maturity there. You're waiting for a significant hardware upgrade. Are you going to have a flip phone, in terms of the foldable phone that you could see come out, in September? But the reality for Apple from a stock, AI is really going to be the swing factor for the stock in terms of them monetizing a subscription service as the consumer AI revolution ultimately goes through Apple.
And what does Apple need to do with the AI? What do you want to see from them as a functioning AI on their phones?
Well, you need a subscription service. And I think that's what Google obviously is helping that with Gemini. You need to lay out the strategy for developers. And you need ultimately to be the platform. Think about everything that OpenAI is doing. Google, go to Microsoft. I mean, across the board, Anthropic and others. Apple cannot be from the outside looking in terms of the fourth industrial revolution.
Now, any concerns that people are going to wait for that and sales may slump again?
Look, I mean, there have been some concerns about that. I think that quarter last night put some of that to bed. I think if you look at the next few quarters, it's going to be pretty stable demand. And then it really comes down to, can they execute, keep margins intact, and then ultimately monetize on AI? That's really the game plan for Tim Cook and Apple in 2026.
What's the key thing then for keeping the margins in line then?
I mean, they're probably going to have to raise prices. iPhone 18, probably $100, $150. Look, around the edges, they could cut and they could absorb some of that as well. But especially with tariffs and just rising prices on chips, they're going to have to raise prices.
And where do you see that? Where do you see that ending up? And will the consumers have a stomach for that?
Yeah, I mean, there'll be some maybe churn, pretty minimal, probably 1-2%. But they'll probably raise $100, $150 on the Pro and on the Pro Max going into iPhone 18. But for them, it's really going to be, I think, less of an issue from a margin perspective and making sure that there's a balancing act in terms of making sure that they don't hurt demand too much at this important stage.
And what kind of headwinds could there be coming up in the next 6 months, next year?
Look, I think the biggest overall headwinds are just executing on their AI strategy.
That's
I
it.
mean,
It
it's a
comes back.
little
It
kind
all
of,
comes back to AI, right?
look, because it's the boy that cried wolf, right? I mean, in other words, every year investors are patient. 2026, rubber meets the road.
So they got to show up and show up with their AI. All right, Dan, thanks very much for joining us. We appreciate it. Dan Ives is Managing Director and Senior Equity Research Analyst covering the tech sector at Wedbush. Coming up, gold prices are falling on signals that U.S. President Donald Trump will announce his nominee for the next Federal Reserve Chair. More on that when we come back. We're watching the price of gold today after the precious metal briefly dropped below 5,000 this morning. For his analysis on the latest moves in gold and silver, we were joined earlier by Kenneth Hoffman, head of commodity strategy at Red Cloud Securities.
We've had a thesis that gold would do very well over the long term, and we're in a long-term gold bull market because of what we call de-dollarization. And I think these past week has showed you exactly why you want to own gold and what is driving gold, which is the U.S. sort of leaving the world market and less dollars being needed, and therefore gold is where you want to be. Why? What we saw this week was, remember on Monday and Tuesday, Japan was trying to prop up its currency, so it was selling dollars and buying yen. That sent the dollar index down significantly. The dollar depreciated in value, and gold took off. What we've seen over the last 48 hours is really the reversal of that trade. Particularly last night with the president nominating of the 4 people for the Fed, this person seems to be the least likely to sort of lower rates quick. And the market saying, wait a minute, we thought Trump wanted far lower interest rates. Maybe they won't go down as fast, and therefore the dollar appreciated again, and gold and silver really took it on the chin. However, I think Trump's long-term goal has always been, and he's stated this many, many times, to lower the value of the dollar. So that tells you as he goes ahead with his quest to lower the value of the dollar, gold is going to have probably a much better run than we thought because of the volatility we're seeing today.
Interesting. I guess all of that just goes to show we are in what we already knew was very unpredictable times, and that continues. So do you think that what we're seeing today in terms of the price lower, a bit lower, is just a minor blip for gold?
I think long-term it will be, but again, it's instructing investors to watch the dollar, that gold is really replacing the dollar as one of the world monetary instruments, and that trend is specifically tied to what the dollar does over the long term. And we did see the dollar decline around 10% last year. It's slightly down this year, and I think what's really important about that is as it goes lower, and, you know, looking at the Bloomberg US dollar index here, he wants to target something under 1,000, probably something in the 800 to 900 range. The reason he wants a cheap dollar is to pay off the massive US deficit. But as those things come to fore, that's going to be a very powerful motivator to the price of gold going forward.
I want to talk about the price of silver and even copper if we can in a couple of minutes, but just still staying with the price of gold, right? Like we've seen where gold is sitting. Bitcoin still showing wide price swings. I know everyone talks about gold being that kind of safe haven. Are investors, do you think, maybe taking more of a risk than they realize with gold compared to Bitcoin, or what do you think?
Well, I think the volatility of gold has definitely picked up. It's nowhere near Bitcoin, and I've never been a big fan of Bitcoin, but I am a big fan of gold. And the reason being, you know, that central banks can acquire gold right now. And it's a tier 1 asset, which it hadn't been in the past. And that is the trend that is your friend, which is central banks around the world, the biggest and most liquid players in the world, have been buying gold and will continue to buy gold. Now, around that is investors positioning, and that's what's giving us sort of the high volatility here. But the trend is your friend here. And silver is, you know, less liquid than gold, and so you're starting to see it move around even more higher volatility than gold.
I was just about to ask about silver, right? Because we're seeing it dropping below $100. Is that I take your point. It's more liquid than gold, but is that some of the same reasons we're seeing gold drop as to why we're seeing silver dropping?
I think they're completely in sympathy, particularly for, remember the big retail has been a big buyer of silver. And I think when, retail tends to, the reason is silver's a lot less expensive. It's a lot easier to buy an ounce of silver than an ounce of gold. And so it typically does have that higher volatility around gold. To me, it sort of has less of a central bank impact, which is why I prefer gold over silver. But the two are always tied at the hip. And in this case, it's, they're both showing that same volatility, with silver, which had much more volatility on the way up, showing that pullback, much more volatility on the way back down.
What about the price of copper as well? Like, we've seen copper hitting some record highs recently too. What do you expect to see in the, near future with copper?
I'm less bullish on the base metals than I am on gold. Again, sort of going to what the U.S. is doing in terms of trade. At Red Cloud, one of the things we talked about is chaos will be commonplace, and we don't think that Mr. Trump will change his ways. And so the tariff trade-off and impact on global economies, we believe will send the U.S. economy, into a bit of a 2026 issue. Once we get to 2027, love copper because of AI and infrastructure and electrical. But we think this year could be difficult. We're already starting to see pretty significant weakness out of China, which is the biggest trading partner with the U.S. And I think as other trading partners are less and less inclined to trade with the U.S., it could cause problems for the U.S. economy. And so I think at the end of the day, copper to me is something that has more downside than upside risk at this point in time, until we get into the huge part of the AI boom, which I think starts to occur after 2027.
Lindsay was speaking with Kenneth Hoffman, head of commodity strategy at Red Cloud Securities. When we come back, the latest GDP report offers new insights into Canada's economy. That's after this. Canada's economy stalled in November, with GDP flat month over month and falling below expectations. The drag came from goods-producing industries, which fell 0.3%, marking the third decline in 4 months. Other industries, including manufacturing and agriculture, forestry and fishing, also negative contributors. Shares of Bombardier are taking a hit, down more than 8% after U.S. President Donald Trump threatened to impose a 50% tariff on aircraft from Canada sold in the U.S. In a post on Truth Social, Trump accused Canada of refusing to certify certain jets made by Gulfstream, and also threatened to retaliate by decertifying Bombardier Global Expresses and all other new Canadian aircraft. Industry Minister Melanie Joly says Canada's aviation regulator is in the process of certifying Gulfstream jets. Shares of Amex are trading lower after the credit card giant reported profit and expenses that fell short of Wall Street expectations, off by about 3.7 right now. On the upside, revenue topped estimates and Amex posted higher than expected transaction volume. The company is also raising its dividend by 16%. And looking at the markets, the sell-off continues, off by nearly 900 points, 2.68% on the TSX. Metal, miners, those are the ones taking the biggest hit right now. South of the border, concern over the next potential Fed chair has the markets cautious. A bit of a sell-off going on down there. You can see the S&P 500 off by a half, the Dow by 0.9, and the NASDAQ off by about 0.6. Well, Canada's economy stalled in November. The latest report from StatsCan says the country's GDP flattened month over month, below expectations. For perspective on that, I'm joined by Michael Davenport, senior economist at Oxford Economics. Michael, thank you as always for joining us.
Good morning. Thanks for having me.
A little less than what the analysts were expecting, not much, but your thoughts on this?
Yeah, so StatCan's GDP release this morning showed that the Canadian economy really stalled in the fourth quarter and may have even slipped into reverse slightly. So GDP was flat in November. That follows a large 0.3% month-over-month decline in October. And StatCan's flash estimate for December actually shows a very modest 0.1% rebound. Overall, this leaves growth for the fourth quarter tracking slightly in negative territory. And as you mentioned, the November GDP release was slightly below StatCan's flash estimates, the consensus expectation of economists, and our expectations as well.
Are we now starting to feel the full effects of tariffs? Is that what's driving this?
I think particularly in November, it was more than just tariffs. There were a few sectoral factors that kind of move different sectors in different directions. So first, we had labor disruptions in October in the retail trade sector, the transportation and warehousing sector, as well as the education sector. All of those were resolved. And so while they did weigh on output in October, they led to a little bit of a rebound in those sectors in November. At the same time, there were big declines in manufacturing and wholesale trade. While in the manufacturing sector, that was fairly broad-based and likely in part reflects the impacts of tariffs and broader trade policy uncertainty. However, there's also, StatCan mentioned in the report, and we've seen other media reports of this lately, that there was a bit of a global semiconductor chip shortage that disrupted production in the Canadian auto sector. So we saw big declines in auto manufacturing output, as well as in the wholesale trade sector, auto wholesalers output. And so that was another kind of one-off factor, could continue going forward, but that was something beyond just tariffs and trade policy uncertainty that weighed on Canada's economy in November.
Is there one number that looks good, but when you kind of dive deeper into it, it's still concerning?
Yeah, I think the retail trade sector in particular, I mentioned, so there was a rebound in November. That largely reflected the end of a strike for workers in BC liquor stores. So there was a big rebound in food and beverage retail sales activity, and that pushed up the headline retail sales numbers we got just last week, and obviously led to overall retail sales output, or retail trade output, being a little bit higher in November. But if you look at the trend, and you look at the trend in overall consumer spending, it's been quite flat, really, for the second half of 2025, and drifting a little bit lower. We think overall consumer spending is likely going to remain weak after contracting in the third quarter, and that largely reflects, in part, sort of this elevated uncertainty, increased job insecurity from the trade war, but also fundamentally much slower population growth.
And then moving forward, what are the numbers telling you?
Yeah, so that's a great question. Looking ahead, we think Canada's economy is likely going to struggle to grow in early 2026. As I mentioned, it looks like the fourth quarter is going to be right on the edge, right around zero, could be a slight negative. And while we think the economy is going to avoid a recession in the near term, growth is likely to remain in the low single-digit range in the first half of 2026 as the economy continues to contend with elevated trade policy uncertainty, obviously still significant U.S. tariffs in effect on particular sectors, and the big elephant in the room that Canada's population is now shrinking. We think that's going to sort of limit the speed limit or weigh on the speed limit for Canada's economy in the first half of 2026. That being said, 2026 could very well be a bit of a tale of two halves for Canada's economy. The upcoming USMCA renegotiation will be a pivotal fork in the road that could send the Canadian economy in diverging directions depending on its outcome.
And how much of a divergence do you think we'll see with that?
Well, so our baseline expectation continues to be that there will be a renegotiation of the USMCA, and that will lead to lower tariffs than what we're seeing today between Canada and the U.S. We think in that scenario, there will be a pickup in growth starting in the second half of 2026 and moving into 2027 as we get a bit of a rebound in business investment and exports. That being said, if the negotiations were to turn sour, and in the somewhat unlikely scenario that the USMCA trade agreement actually falls apart entirely, we think Canada's economy would actually slip into a recession in the second half of 2026, and output would probably be on a permanently lower path.
Okay, and is there any kind of an impact with the different? I mean, the U.S. GDP was, depending on who you talk to, it was above 3. Some said, I think it was 5 was the number that was bandied about. Is that having an impact that they're going in such a different direction than us right now? And also the potential for their new Fed chair. Will either of those weigh with our economy at all?
Well, I think on the Fed chair front, we'll see what happens. I mean, we don't think the new Fed chair is necessarily going to lead to a substantial sort of deviation in the path ahead for the Federal Reserve. And the U.S. economy has continued to outperform the Canadian economy. That's largely in recent quarters been tied to strength in business investment and the ongoing build out in AI investment, particularly investments in data centers and the like south of the border. We have not seen that north of the border in Canada yet. On the contrary, business investment has actually been quite weak, particularly because of the impact of trade policy uncertainty and how that's causing firms to really pull back on new capital expenditure plans and focus more on just maintaining existing levels of production, looking more at repair expenditures and things like that. So overall, we think that U.S. outperformance relative to Canada's economy is likely going to continue. However, as I mentioned, if we do get a resolution of some trade policy uncertainty, we do get a renegotiation of the USMCA that leads to lower tariffs, we could see Canada's economic outlook improve quite a bit and growth pick up in the second half of 2026 and moving through 2027.
Okay, well, we'll leave it there, Michael. Thank you, as always, for joining us.
My pleasure. Thank you.
Michael Davenport, senior economist at Oxford Economics. Coming up, Trump is set to nominate Kevin Warsh as Fed chair. Our next guest will break down what that means for the Fed's independence. U.S. President Donald Trump announced on Truth Social that he intends to nominate Kevin Warsh for Fed chair. The news comes amid rising concerns over the Fed's independence after current chair Jerome Powell said the Department of Justice had threatened criminal charges against the Fed. To help us break this all down, we're joined by Terry Wiseman, Global FX and Rates Strategist at the Macquarie Group. Terry, thanks very much for joining us.
My pleasure.
Initial thoughts on Trump's announcement. It did seem to come a little bit out of the blue.
Well, not in regard to the idea or the narrative that Trump was going to nominate someone who sees things the way Trump does. In fact, it would have been very unusual, and I think the surprise or the bigger surprise would have come if it was someone who doesn't agree with Trump on most issues. But I have to say, it's not just that Rick Ryder, another prospective nominee, or Kevin Hassett, another prospective nominee, agree with Trump on most of the things pertaining to monetary policy today. Kevin Warsh certainly also agrees with Trump on the things that need to be done at the Fed today. Now, that doesn't necessarily mean that he wants more or less Fed autonomy, but I do believe, like Trump and like Rick Ryder and other people in Trump's circle, he is a proponent of reform at the Fed. And on some issues, he's a fan of autonomy. But on other issues, he certainly isn't a fan of autonomy. So, for example, he wants more dialogue between the Fed and the Treasury, which speaks to less autonomy. At the same time, he has criticized the Fed for straying into areas that are not within its mandate, issues pertaining to diversity, issues pertaining to climate. In that respect, he wants less autonomy, if you see what I'm saying. Mm-hmm. It really depends where your value system is, whether or not you believe that these are the right things to do or the wrong things to do.
And just going back, I mean, the market seemed to be reacting as if he is a hawk, but you don't think he hasn't been a hawk for a while.
That's right. If anything, the way to describe Kevin Warsh, as we could maybe have described Rick Ryder or Kevin Hassett, or the recent incarnations of their policy views, is that he's not so much a hawk or a dove. Rather, what he is a follower of Donald Trump. Back in at a time when Kevin Warsh was sitting at the board, let's say from 2006 to 2011, he was against QE, and I think because of that, people regard him as a hawk. But keep in mind, Donald Trump was also against QE during this period. When Trump shifted to becoming a real dove in 2019, let's say, when he berated Chair Powell for not doing more QE or restarting QE, Trump became effectively a dove. It was around the same time that, or shortly thereafter, that Kevin Warsh became a dove as well. And you can see in recent writings from Kevin Warsh that he also agrees with Trump these days with regard to what interest rates should do. He thinks they should be lower. So I wouldn't call him a dove or a hawk. People do move from time to time from one side to the other, as we saw the president do. When he was a private citizen, he was saying one thing. When he was president, he was saying another. I think that really the pivot here is whether or not he's a follower or not of Donald Trump. And all the evidence so far suggests that he has been. And there's a historical record to support that view.
And what changed? Because he was up for the position back in 2017 and lost to Powell. What do you think has changed from then till now? Is it Powell that has changed, I guess, if you want to call it that?
I think what has changed is Donald Trump, the President Trump's disposition to who he wants to listen to when it comes to important policy decisions and policy appointments. So if you recall, it's believed certainly that when President Trump nominated Jay Powell to the role of Fed chair, he was prompted to do that or prodded to do that, if you will, by the Treasury Secretary at the time, Secretary Mnuchin. Well, it turns out, of course, that President Trump was dissatisfied ultimately with the choice he made. And if anything, that would have left a bad taste in his mouth with regard to listening too much to what your Treasury Secretary says and not going with your gut. So I think he has gone with his gut, and he went with someone who he felt was a loyalist. And he has evidence of the fact that that Kevin Warsh is a loyalist by simply reading what Kevin Warsh has said over the last 20 years, which has been lockstep with what Donald Trump has said.
Now, and going back what you mentioned about having some things for independence for the Fed and some more intertwined, can that walk be walked?
I think it requires a person of high intellect to be able to walk that fine line. I'm not saying that President Trump is not a person of high intellect, but the way he articulates his view with regard to Fed independence is sometimes muddled. I think Kevin Warsh will do a better job of walking that fine line. He will say, presumably, as he has said before, that in some regards the Fed should be autonomous, but in other regards it shouldn't be.
And I just want to go back why do you think the markets are reacting the way they are then to what's unfolding?
Because the markets have an institutional memory of a person who was very much unwilling to go along with his colleagues in 2010 and 2011 with the second round of quantitative easing. So he's been labeled a hawk because of that voting record, if you will, and the public pronouncements he was making at that time. This is very important, by the way. He is institutional, but he's not so institutional that he was willing to go along with his colleagues back then. In fact, he walked away from the job before I'm speaking about Kevin Warsh here, before his tenure ended because of that disagreement. So he's an iconoclast for sure. Well, guess who else is? President Trump. In that respect, they see eye to eye.
Can you see the markets eventually changing their memory and seeing the new Warsh?
Well, if they read what I wrote this morning, for example, that might convince them. But I'm not sure how many other people in the marketplace are saying what I'm saying today, which is that Kevin Warsh, if you will, is not that different and will not provide the economy with anything that different, whether it's good or bad. I'm not casting a judgment here, but not that different from what a Rick Ryder would have presented or a Kevin Hassett would have presented.
Okay, Terry, thank you very much for joining us today. We appreciate it. Have a great weekend.
My pleasure.
Terry Wiseman is Global FX and Rate Strategist at the Macquarie Group. Coming up, we'll check on the markets on Bay and Wall Street. With inflation still squeezing household budgets, Canadians say cutting grocery costs now outweighs concerns about housing costs. This according to a new Nanos research poll. CTV's Alex Karpa has more.
Hard to make decisions.
A trip to the grocery store is not an easy one for Ben Nye.
It's really expensive here.
Soaring prices at checkout are forcing him to carefully consider what meals he can afford to make.
That's not bad. $4.99.
Being currently unemployed and searching for work has made it a struggle to pay the bills.
As a consumer, we're being hit hard, and it's being difficult for us to actually be able to afford anything anymore.
Nye has even resorted to selling many of his things just to cover costs.
It's difficult trying to make ends meet.
Like Ben, many are feeling the impacts of rising grocery prices. A new survey finds that the biggest concerns around costs for Canadians is right here at the grocery store. A new Nanos research poll for CTV News finds grocery prices worry Canadians more than housing costs as inflation continues to rise. More than half of Canadians say groceries are top of mind when looking to save money this year, followed by housing at almost 25% and healthcare at nearly 10%.
It speaks to the pressure that Canadians are under and how groceries are at the top of the list, significantly ahead of things like housing and healthcare and fuel and entertainment, all those things.
But experts warn that relief may not come anytime soon.
The story on tariffs are going to continue as we're trying to renew CUMSO with a very unfortunate negotiating opponent in the United States. Could be looking at, a bad year next year as well.
Let's try this.
As prices continue to climb with no end in sight, Nye says he will do whatever it takes just to stay afloat. Alex Carpa, CTV News, Winnipeg.
Well, the day Oshawa, Ontario auto workers have dreaded for months is here. GM Canada cutting a shift at the city's plant. More than 1,000 workers losing their jobs. CTV's John Valley-Rao has more.
At this GM plant, the plunging temperatures outside match the mood of its workers feeling left out in the cold.
Feeling bad because you got bills to pay.
At the Oshawa plant, 500 full-time GM jobs are being cut, along with hundreds more in the supply chain.
I feel really bad. My son's losing his job. He was hired in 2022.
Back then, a third shift was added amid heavy demand for the Chevy Silverado trucks built here. That extra shift, though, is being eliminated on Friday. GM announced the change was coming 8 months ago, not long after the U.S. president brought in tariffs aimed at the auto sector. In a statement, GM confirmed Oshawa Assembly will return to 2 shifts of production, but adding it's also continuing preparations to build the next generation of gas-powered full-sized pickups, reinforcing Oshawa's future. Still, while GM says it's committed to staying, the union says some truck production is being shifted to this plant in Indiana.
It's devastating news. We have a large portion of our membership that won't have a job come tomorrow morning at 6:30.
It's just the latest blow after GM last year idled this plant in Ingersoll, Ontario, and Stellantis shut down a plant in Brampton. Hoping to give the sector a boost, Ottawa has agreed to potential future talks with South Korea that could include automaking. According to Hyundai and Kia, they sell annually around 250,000 vehicles in Canada, yet don't manufacture here. Still, some think a deal could draw the ire of the U.S. president.
Trump is coming after investments that are going anywhere other than the United States. So to announce a $3-4 billion investment in the Canadian market right now isn't exactly going to help the image in the United States, and it might put a target on your back south of the border.
Meanwhile, some at this GM plant are hoping the third shift could be reinstated if Ottawa reaches a trade deal with the U.S. John Valley-Rao, CTV News, Oshawa.
Well, Market Call is coming up next, and today on the show we have Brianne Gardner. She is Senior Wealth Manager at Velocity Investment Partners, Raymond James, and we'll be taking your questions on Canadian and U.S. large caps. All right, let's take a look at the markets. Not sure we want to today. It is a bit of a rough stretch going on right now. Both sides of the border. Look at the TSX right now. That is not a mistake. That is the actual number for the TSX right now. Down almost 3%, 2.8% right now. Gold is the driving factor here on that. And it's taking a look, just going to the sector itself. The materials index is off itself by 7.45%. And some of the big losers today, you see them up on the screen. Aya off by 12.6. New Gold off by 13.8. First Majestic down by 12.14. Almost all of them are in the black. Are in the red. There is not much showing any green in that sector for today. Again, the materials index being driven by the gold and silver prices plunging right now. So you can see they are all taking a hit. A couple of Canadian stocks we want to talk about as well. And the first one is Bombardier. That's another one that is taking a hit today because of comments by President Donald Trump south of the border. You can see it's bounced back a little bit. And that's probably on the news that we heard from Melanie Joly, the industry minister, that they're working on some kind of a resolution to what is unfolding. It's because President Donald Trump threatened to slap a 50% tariff on aircraft from Canada and decertify all the new planes made here unless Canada certifies certain jets made by Gulfstream. That's what he is accusing Canada of doing. And just about 20 minutes ago, half hour ago, the industry minister Melanie Joly announcing that they were working on this and there may be a solution to this coming shortly. But in the meantime, Bombardier taking a hit, also took a hit on Monday after that plane crash last week in Maine that left 8 people dead. The other one we want to look at, CN Rail as well. Disappointing, underwhelming, actually, I think is one of the terms that people have used for their earnings that just came out. The shares are off by almost 3% right now. That's just probably just tying in with everything else everybody's feeling today. Low side expectations, though, for their guidance is how they described it, 2026 guidance. The company's fourth quarter adjusted earnings per share, though, beat the average analyst estimate, but everything else not really good. The Street was expecting CN would try to underpromise and overdeliver, but the company said only that it sees flattish volumes in 2026 and expects CPS growth to slightly exceed volume growth. So not a good day pretty much anywhere on the markets. And that is it for the morning markets. Thank you very much for joining us. I'm Roger Peterson. And have yourself a great weekend. We'll see you back here next week.